Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I'm going to show you some charting that isn't produced by me. It was produced on Twitter. I saved it and put it in the presentation to show you guys. Some of these charts are North Star's charts off Twitter. That's where I grabbed it. And I know he posted them and said share with everyone. Well, I'm going to share some. They are pretty good. And obviously, I chart the same way, but it's good to see from other people how they chart things and get you a second opinion, basically. So let's go through them real quick, and I'll give you my financial opinion along with it. And let's dive right in. So we've got some charts back here. Again, this is from NorthStarBadCharts.com, just to let you know. I got it from Twitter. Twitter is where I got it. And what this is the 10-year yield. And what he's saying is a paradigm shift is underway. You've probably heard me say that before. And what you have is an uptrend support line, a downtrend support line, and then a new support line that's basically forming and a breakout of that resistance line. And these are shifts within the market. This here is a paradigm of an inflationary environment from 1980 all the way down till very recently here. This entire move here is a disinflationary slash deflation, however you want to call it. It'd be disinflation is what I would say. Disinflationary environment where the demographics, what we're basically doing here and what I found through my research is that generally speaking, the demographics is what drives these interest rate lines. So we had an increasing demographic. The rate of increase was pretty good. We had a declining rate of increase in this period. Now the millennials, which has a little bit larger rate of increase, is coming into home buying years, and that's what's causing, in my opinion, this breakout paradigm shift. It also can be driven by credit cycles. And I'll show you what the money supply looks like. He has a really good chart that has this. But what he says is, notice the shift from a rising support line to a declining resistance line. The pain line is what he calls it. We are now moving back to having a rising support line. There's our rising support line. So this is a huge paradigm shift. And what this means is the increasing interest rate environments, the ones that look like this, these are inflationary, and they put a different pressure on the system of money to rotate differently than it would in a declining interest rate environment. Declining interest rate environments basically prop up stocks. They force people out of bonds because you can't get a return on your interest. The interest rate is so low that people start to speculate more on other investments. Now, since we have interest rates going up, money's starting to rotate out of bonds. That's why the interest rate's going up. And also stocks. Stocks don't like increasing interest rate environments because that money is going to flow out and seek other assets to get inflation protection. So money's going to rotate similarly coming up to what it did in the 1970s. The big move from 2004 to 2008, that bull market in commodities, was not a large bull market. It's a small bull market because we were still in an overall trend going lower. That was just the commodities lining up in a small demographic. We have a larger demographic, commodities lined up, and the interest rates are also lining up, all in alignment. That is what we want to see. This will be a big move that will be coming. So it'll be more like the 1970s than it was in the mid-2000s because of the interest rates, the liquidity in the system, and the changing paradigm of those interest rates. I got this one from 9 Point Partners, or 9 Point. This is Eric Nuttall. This is the U.S. Big Three, crude plus gasoline plus distillate inventory. And I just wanted to show you guys and give you an update that we are still declining in our inventories of crude, gasoline, and distillate. We are still drawing down, and there are big problems in oil. And I know people get very, emotional based off of the price changes. But the fundamentals have not changed in oil. They have not changed in uranium. They have not changed in commodities or anything. So I am staying long myself in all of these sectors, irrespective of short-term price movements. This is Derek Quick. I just threw this up here. It says, Rick Rule said in uranium investing that he wished he did less trading, trying to time the uranium market, and invested sat on the ones he did his research on with great management teams. He would have done a lot better, he had said, with less stress and had more free time. I agree. Another one who's in the camp of sit and wait. Now, remember that the interest rate line, how interest rates and the paradigm shift and all that. Well, this is your consumer price index for all urban consumers. So this is your consumer price index. We had a line that was relatively, if you were to do a trend line and you were to look at the slope of the curve is pretty minimal here. Then the slope in 1970s, early 70s, changed dramatically to a steeper slope for the consumer price index here. Then if you look recent, we took another leg higher, which is basically going vertical. And what's crazy here is the steepness here, and basically the slope of the curve, the line, did not really change throughout time. It's basically the same slope of curve here, same slope of curve here, and now we're going vertical. Is there something that will stop the slope of that curve? I don't know. And if nothing can stop that, we are exactly where we want to be. And what this is charting could potentially be a resource problem, getting resources out of the ground. And money will have to rotate to those resources. Here's another one. This is the Globalx Uranium Ura versus Bitcoin. And we were in a large decline for a period of time here. And what you notice is that we've broken the downtrend line. We are starting to turn back up where URA, which is an ETF, is starting to outperform Bitcoin. Is this going to be our future here where we start to come back up on this curve? It says, if you trust technical analysis, you would have rotated out of Bitcoin into uranium around October, November last year at this backtest. URA will beat Bitcoin unless this ARC support line is broken. It's that simple. And I think he's right. I'm not in Bitcoin. I don't necessarily like Bitcoin. But his technical analysis and what we're seeing and his conclusions are all correct. And I have found things to be very similar to what he's finding. So here's Energy Fuels. This was also off of Twitter. Here's our break. Line that's breaking out, moving up. Now, this could move sideways. It could pull back. It can do a lot of different things, but the target area is much, much higher than where we are today. And this is on a logarithmic, chart. This is a non-logarithmic, non-log scale. And looking back at the old bull market from 06 to 07, UU rose 2,000% in 8 months. That is ridiculous movement. Then we came in, we always do this double hump. I call it the double hump. You get a huge move, you go into a double hump, then you go into the valley of despair, and we're starting to come out of that valley of despair. It did the same thing here. It's a double hump. You go into the valley of despair. It's a big valley of despair here because it starts here, and your fractal here is massive from the bottom of 02 to 03, and then you have this large pullback. We could have pullbacks in here. That had pullbacks, and it didn't really launch till 06. And it could happen anytime in this general vicinity. But that's the UUUU, what it looks like. We already went through the valley of despair. Now it's just going to be volatile, and we're going to have to hold on. This is the US 30-year divided by the US 10-year yields. So this is yields. What this is saying is when the 30-year yield outperforms the 10-year yield, that's what this movement is going up. So this is the 30-year outperforming the 10-year when inflation expectations, or I should say not expectations, when the yields on the 30-year, when inflation expectations on the 30-year exceed the expectations on the 10-year, gold starts to move higher. That's what we've seen in history. We've had a couple of pullbacks in here, but the general trend is when this outperforms, it moves on higher. And right now, we are lining up for the 30-year yield to outperform the 10-year yield at some point here where it turns back up. Every time we've had that turn up, we've had a large move in the price of gold. So it looks interesting here where gold could potentially head higher. And if we see gold head higher, what that means, it's basically a validation that the gold market thinks that we are going to have future inflation. That's really what it's pricing in. Here's the uranium to platinum ratio. And what he's showing here is that uranium will most likely outperform platinum in this. Because uranium, if you've heard me say this before, we've done our calculations on ratios. Uranium is a more volatile, higher leverage play to commodities. And this is exactly what it's showing. Platinum is still cheaper in terms of its overall ratio to other assets. But uranium is also cheap and it has leverage. That's a great combination. Uranium versus natural gas. What this is showing is that uranium is most likely going to outperform to the upside and hit this top resistance zone at some point. So natural gas has been a killer, but it's already eaten up some of its performance, some of its value. The time to buy is when it's at the upper resistance line and ride it on lower. And you want to buy at natural gas when it's cheap against other assets. That was back in 2020, maybe late or early 2021. Now it's uranium's time. Uranium's time is cheap. And again, guys, these things don't rocket immediately. It's just telling us that, and it doesn't have to happen, I should say immediately. It's just telling us it's cheap and that the potential in uranium is better than other assets. One, because it's more volatile, or it's got more leverage to the move, I should say. And two, it's cheap on a basis of how cheap it is. This is the platinum to silver ratio. And I know a lot of people are silver bulls, but if you're a silver bull, you should be an ultra platinum bull. I'm a platinum bull because of this. What this is the ratio. And the ratio is showing us that sometime here shortly, platinum will break out against silver. And that platinum could have a very good outperformance. That's one of the reasons why I continue to buy physical platinum. This ratio is telling me that we're going to see an outperformance of two very cheap metals, but platinum is even cheaper than silver. And we can see a vast outperformance. We have to break above that volume node if you want. It's game on above that. We are still early, and we still have time. All right, looking at DXY, this is the Dixie, the dollar index. The Dixie's in danger of leaving an ugly month. This is a little bit old. It's back in May 30th. The dollar has increased above it, but this is also something we can watch. It is coming up, and sometimes they do a throw over top and then reverse lower. Very much like this here, a little throw over top kind of, and then a reverse lower. The dollar, when the dollar declines against other currencies, it's usually game on for commodities. There's at least that's what it's shown in the past. And that's when commodities really start to take off. So this is something to watch. It has gotten stronger. We're at 104 at this time. We're still high in this resistance zone, but it's one to watch. Uranium spot price. This is the spot price. We hit a target area hit here. We're coming on back, and we'll see if we go to the edge of this arc or back to this trend line. Again, we're probably going to relax potentially for a little bit, maybe not. But we can relax a little bit, move on sideways, and then start up again. And this is the pullbacks in the stock. What this stock is Paladin Energy. I grabbed this from Twitter as well. And these are the pullbacks over time. And this is from 2005. I think that we are still before this, and we're still very early. But these are the pullbacks that we have to endure over this bull market if you want to ride this thing from pennies. This is what, 50 cents, all the way till over $9. It's a big move. But this is the pullbacks you have to endure: 51%, 19, 40, 22, 48, minus 28, 17, and 41. And I probably wouldn't, I don't know. Some of these I'd probably jet out at some point. In my opinion, I'd probably jet out somewhere like over here, just because that's where I think I could recognize the pattern, perhaps, hopefully, or maybe I fall back down here, unfortunately, and sell out this over here. I want to ride the whole thing, so I have to go slow and I have to make sure that I get as much value out of it. But this is going to be a hard ride, guys, and we're going to have multiple pullbacks all through here. It's not going to be as easy as what most people think. So that's what I've got for today. And Paladin's a uranium company. That's a uranium example. So it's mainly uranium information and a little bit of oil information in this. But that's what I've got for the clip, guys, and a lot of good information in there. And it's from a second different person, not just all from me. So you get a different opinion. And everything looks good. It's all intact. We just have to ride through this volatility. It's a rough move. If you guys like the content, give me a thumbs up. Subscribe to the channel. Subscribe to the website if you like the Platinum membership. It's in the description link below if you want to join. And I do this and show this on the website as well. And that's all I've got for today. So we'll catch you next time. Thanks for listening. This is Finding Value.